to kick off the week, we will be joined for a very rich discussion by a great panel of guests to discuss Nigeria's equities and fixed income markets. However, just before that, let's check on the major markets in the region, starting with the BRVM. The BRVM 10 index closed trading on Friday at 231 points. That's down just over 0.1%, while the BRVM composite index lost another about 0.1% to 208 points. Total value traded on the day was 198 million CFA francs. The currency currently trading at 504.5 to the US dollar. That's down 1% for the year. And moving on to Ghana, the GSC composite index closed trading at 1,910 points. That's up 0.7%, taking its year-to-date change to 59%. So it continues to lead other markets in Africa. The GSC financial stock index also up 1% to 1,650 points. Year-to-date change for that index stands at 58.7%. On the currency front, the Ghana cedi unchanged at 2.04 to the US dollar, keeping its year-to-date loss at 6.8%. Now moving on to Nigeria, the largest market in the region, the NSE All Share Index closed on a positive note on Friday, but only just up about 0.1% to 37,382 points. The gainers on the day included the likes of Evans Medicals, May & Baker, IHS, Ikeja Hotels, and IPWA. We also saw a few other large cap companies gain moderately. Year-to-date, the market is up 33%, but traded volumes on the NSE fell 56% to 2.9 billion last Friday, reflecting investor caution and the recent decline in foreign investor flows into Nigeria's stock market and bond market. The NSE All Share Index dipped 4.3% in June, while bond yields spiked amid a sell-off by foreign investors. To discuss the outlook for Nigeria's fixed income and equity markets, I'm joined in the studios by Winston Osuchukwu, who's the CEO of Harvest Capital, and Femi Oladeyin, a partner at Argentile Capital Partners, and Charles Robertson, Chief Global Economist at Renaissance Capital, will be joining us on the line from London. Gentlemen, thank you so much for joining us. All right, so maybe we should start with the equity market. And like I just mentioned in the intro, we saw 2.9 billion naira worth of trades on the day. To me, that reflects some caution from investors, particularly the local investors, but even more so the foreign investors, because we know what happened in June. We saw that sell-off from emerging markets. It hit our bond market, it hit our equity market. Your thoughts on where the market is likely to go from here? Let me start with you, Winston.
Well, I think what we've seen is a little bit of a false start. If you look at what came out of Ben Bernanke's statements, right, and the minutes from the FOMC meeting, they talked about how they would stop QE, not that they would stop QE. So and people it was a bit of a overreaction, a bit of a head fake. If you saw what happened on Friday, the S&P 500 closed at all-time highs. I think the Australian dollar was up 9 cents on the US dollar. So you could see a general strengthening of all currencies that are backed by global commodities. And you could also see gold prices start to pick up again. If you roll that back into what happens in Nigeria, Nigeria is we're in a kind of a Goldilocks moment. We're a great place to be. Everybody wants to be here. The rest of Africa has lost a little bit of that clarity. The fear was that North Africa would have come back by now, especially places like Egypt, but Egypt continues. The turmoil and uncertainty in Egypt continues. So we are in a Goldilocks zone for a little while, and going into the 2015 elections, right, as long as we keep things even-keeled, I think the markets on both levels will do very well.
Right. Femi, let me get your thoughts, particularly the sentiment from the local investors. We know foreign investors have been key. They have been key for the most part of the last 2 to 3 years, as we saw local appetite for equities wane. Your thoughts about the appetite of local investors for equities, given the fact that we're now seeing yields a lot higher than they were maybe a month ago in Nigeria?
Well, I think it's going to continue to be a challenge for local investors. The situation has been that you've seen a strong rally in the top tier of the market. Yeah. And a lot of local investors probably benefited a bit from that. Biggest challenge for the market, obviously, is being able to juggle the high yields that you're getting from the bond market, especially from a PFA point of view, and being able to match that with the long-term, positives that you can expect from the equities market. Right. I think that the strength in the market has largely been driven by the international investors in the market, and that is likely to continue for the short term until we see a recovery in the IPO market. And I think that's always been my message. Right. We've got to see a recovery in the primary market where investors start to think long term, start to trust companies to be able to commit cash to them for whatever projects or whatever transactions they're looking to do. Right. I think when we see a recovery in the primary market, then you can start to expect that long term the local market will be able to drive growth going forward. I think one of the most interesting things that has happened in the last 2-3 years has been the correlation of the Nigerian market with the global market.
Absolutely.
5 years ago, we used to actually talk about complete lack of correlation.
We never followed them.
It
was like they were over there,
yeah,
we were over
here. But today you can see that correlation has tightened dramatically.
Sure.
And that's basically driven by currency flows are becoming easier. And investors are able to basically just drive investments going forward.
All right, I want to bring Charles into the discussion. And Charles, Winston mentioned Egypt while he was making his points earlier, and one gets the sense that Africa is seen as one big pot for investment, and clearly what happens in North Africa is something that will be on the minds of many investors going forward. Your thoughts about the appetite for Africa risk right now, and particularly Nigeria risk?
Well, I think the big problem for investors is that firstly we've had a great performance already on equities this over the last 6 to 12 months in sub-Sahara. The change in tone from the Fed, I think, is right that we can't be sure that they're going to do tapering this year, but you can understand that Bernanke wants to start that process before he leaves office next year.
Right.
And I think what investors are going to be looking at and focusing on today is what's sold off the most. And markets like Nigeria have actually held up really well. FX reserves are down just a couple of $1 billion from the peak in April. They're around $47 billion now. That's telling you there has not been much outflow on the Nigerian local fixed income market. There's been a resetting of rates higher from the kind of the near bubble rates of about 10 or 11% a couple of months ago on the long local bonds to around 13.5 now. There's been a resetting of rates higher, but there hasn't been as big a sell-off in Nigeria as elsewhere. And I think what investors are going to be focusing on in the next few months is what looks cheap. And it's probably the BRIC countries. It's not that people don't like Africa. They're happy with it, but I think what looks cheaper today is some of the more established emerging markets.
Right.
And that's likely to attract the new flows. And that means I don't think we're going to see a rerun of the rally in Nigerian rates that we saw earlier this year. I doubt we're going to see that over the second half of 2013.
Right, but what are your thoughts on the Eurobonds that, of course, Nigeria issued Eurobonds recently? It was massively oversubscribed, at least that's what many people think. So at about 6% thereabout these days. Your thoughts about the attractiveness of Nigeria's Eurobond in the context of other emerging markets?
Well, it has changed. About 6 months ago, I was saying that the 4% yield you were getting on Nigeria's 2021 Eurobond was indicative of a dollar bond bubble. And that generally, I was suggesting this was not an area that anyone should be exposed to. At 6% in dollars, it begins to be attractive. I personally still think the local rate story is more interesting. You may not get a great rally, but at 13.5% yields on local currency bonds, I would prefer that than 6% in dollars. But at least 6% in dollars is giving you a reasonable return. 4% in dollars a few months ago was not giving you a decent return, I don't think.
Right, Winston, are you that bullish about Nigeria's local debt? Because particularly for foreign investors who will of course take that exchange rate risk, we've seen some volatility in the Naira recently. Are you convinced that it's still a good place to be at yields at about 13%?
No, Nigeria debt at 13% is it's a great place to be, because I don't see the currency risk going forward. I don't see the massive currency risk going forward. And as Mr. Robertson just said, if you look at the difference between the 6% and 13% and factor in what might be your currency exposure going forward, the local debt does give you a lot of benefits and upside. And if you look at the local market, well supported by the local PFAs, and there's a general hunger for that paper, I would stay local. I did a lot of work on this, and it's clear. If you look at local currency debt, not just in Nigeria, if you look across Africa, the risk premium that's charged on local currency debt over other BRIC countries and other emerging market countries are completely unjustified. And what you find is on local currency debt, you get a greater return for each unit of risk that you're taking.
Femi, do you share that sentiment?
I absolutely do. Perhaps the other key variable that obviously would drive this is inflation.
Right.
If you continue to have the challenging inflation environment, despite the fact that Nigeria is running at 9.2, 9.3% thereabout. But if you continue to have inflation at that level, then you would always expect that that premium is going to be there between the locally priced debt and offshore debt. I think what ultimately will drive investor appetite in that market, and like Nick has mentioned, you've seen a resetting of rates. It wasn't a sell-off. It was actually people basically saying that, look, there's been a bubble. We've got to reset prices to be able to reflect the current environment. And I think that investors are learning. That's the biggest issue here for me. Investors are learning. In the past, you could have bubbles that just drive on for 2-3 years, but now the reset cycle is shortened dramatically, which means that people are beginning to recalibrate their models almost like on a monthly, on a quarterly basis, and say, look, are all the assumptions we had still valid given the current economic environment? And if that continues to happen, then you're going to see the market become more volatile, but in a shorter band. And ultimately, for investors, that's positive.
All right. I want to take this back to Charles. And Charles, clearly, one of the reasons why we're seeing investors flood African debt these days is just where the yields are in the U.S. And I want to get your thoughts about the outlook for that, given the comments we saw from the Fed this last week.
Our base case is that U.S. Treasuries can't go much higher than here. We were around 2.5%. And I think Bernanke made very clear last week that if they went higher, let's say 3% in the next 6 months, I think the Fed would get anxious and worried about what that would do to U.S. growth. So they would be more likely to not only not taper, but they could even increase their intervention in the market. So I don't see much risk of the U.S. Treasuries going higher from here. And at the moment, U.S. inflation is so low, about 1.4%, that the deflation risk hasn't disappeared. So I think the U.S. isn't. 2.5 is our assumption for the second half of this year on U.S. Treasuries.
All right. I want to bring it back to you, Winston. Your thoughts, and let's take it back to the stock market now. So the debt market looks pretty attractive. You can get used about 13-14%. But what are your thoughts on the valuation of the equity market right now? A lot of people saying that the consumer stocks are looking pretty pricey. The opportunities is really in the banks. Do you share that sentiment?
Well, in general, I'll say this much. The easy money has been made. Anybody that's going to make money in the Nigerian stock market now, you have to get to work. And part of that getting to work is you have to go in and look at each company. You cannot do a broad stroke consumer banking kind of thing anymore. If you look at banks like GTB, your First Bank and Zenith banks, those are richly priced. And if you look on the consumer side, those are also richly priced. But why don't you if you take a couple of steps back and start looking at the second and third tier stocks, I think that's where you'll find, yes, there might be a little bit more risk, but that's where you find a lot of returns. But it requires you do a significant amount of work before you start to put any significant amount of capital at risk.
But Femi, I want to get your thoughts on this point. I really think markets are driven by liquidity. Yes, a lot of people will argue that you have to look at valuations, but at the end of the day, when the cash is there, it has to find a place to go. And so maybe we get a bubble in the equity market, maybe a bubble in the fixed income market. Your thoughts about the trends in terms of liquidity going forward and what that could mean for equities?
Liquidity is very strong in the market at the moment. Whichever way you look at it, there's actually a lot of cash in the system, basically looking for assets. Now, the key driver going forward is you can have as much liquidity as possible, but if asset prices start to become extremely pricey, then investors are going to be cautious. I mean,
I think they're more cautious when there has to be a trigger most times. And
absolutely. What generally happens is that liquidity dries up. So liquidity is quite an important variable, because once liquidity dries up, then people can't get out of assets, and then the panic sets in. So it's a vicious cycle. But I think that the key for me going forward is that people are going to start making comparisons. So you look at the Dow Jones, for example. The Dow Jones, for example, has reached a lifetime high. But from a price earnings multiple perspective, we're at 16, for the Dow Jones. I remember in 2001, we were reaching about 30. So the reality is that from an earnings and growth point of view, a lot of those companies have been able to grow their numbers. You can't necessarily say the same thing about the local market. Price earnings multiples have risen dramatically in the last year. And I think that's the key negative that would ensure that the market isn't going to do much from here. Because until we see significant growth in earnings, we're unlikely to see.
Charles, we really have to wrap up now, but a very quick view on liquidity. Global liquidity, where do you think it's likely to be headed from here?
Well, I think one of the only point I'd add here is that frontier markets have become kind of the sexy area for the last 6 to 12 months. And I think one of the reasons that frontier equity markets have held up better in this sell-off in the last 2 months than global emerging markets is that money's still been flowing into these frontier funds. And when they've seen a flood of cash come into the frontier funds, I think the frontier funds haven't been able to allocate all that cash yet.
Right.
And that's what's been holding up the market. Now, if you're looking into the second half of this year, again, where would new money, where would new retail money or institutional investor money go? Again, to come back to my point at the beginning, I think it's more likely to go into the established emerging markets, like Russia or Brazil, which have been quite badly beaten up, even Turkey somewhat as well, quite badly beaten up in the last few months. That's probably where the new money is going to come from. I don't see a shortage of liquidity in frontier, but I just don't see the extra surge in the second half of this year going into frontier.
Right. I think